And we are live. What's good, y'all? It's your man DL Saint. Welcome. I really want to know podcast. How y'all feeling out there, man? How y'all feeling? Let's check out the audio. Audio seems to be good. How y'all feeling out there, man? We doing what we do here, guys. We doing what we do. Um, Today we're gonna talk a little bit about the housing market, man. I know I haven't really been talking about much, but it's been in the way of housing and all that kind of stuff and the economy, man. But there's so much going on, bro. Venezuela, Greenland, Cuba, Iran, right? Mexico, Minneapolis, like the list goes on and on and on. And it's really easy to miss stuff, guys. Really easy to miss stuff. So um, yeah, that's what's going on with that. So we're gonna talk a little bit about the housing market, bro. Like what's going on with that. Um, so appreciate you, man. Don't forget to hit that like button, man. Subscribe, share, all that good stuff, man. Tell a friend. Y'all know what it is. Let's get into it. And we are live. What's good, y'all? Welcome to the I Really Want to Know podcast, y'all. Get some indeed, guys. Yeah, we've been doing what we do over here, working hard. Had some things. I had some brand new experiences that I experienced here recently. Can't talk about it yet, but I will talk about it at some point. You guys are gonna get a kick out of it when I actually do tell you what happened, man. But you're just gonna have to wait and see. We're gonna have to wait. Can't talk about it just yet. We're gonna have to wait. But once we get into it, bro, and we're definitely gonna keep doing what we're doing. We're gonna keep pushing forward. Um, as far as content, you guys see I'm putting out all sorts of content, man. Historical content, talking about our history is American history. Well, I'm talking about Black history and, just kind of um, people you may or may not have heard of, and things is going on with that stuff that I'm learning. So it's not like I knew all this stuff, guys. Like the video we just put out about elevators, bro. I didn't know. I didn't know. You know what I mean? So I went, looked it up, put together a script, got some pictures, threw it together, man. I hope you like it. I even went and started another YouTube channel that was like just solely for that. But I didn't like make hard copies of what I was doing. I went, set up a whole nother Google account, made an email address and all this stuff. And I had to did banners and all that, man. Got the channel set up. I think we had like 4 subscribers. I'm putting out videos. I had 2 videos on there. One about the triple nickel, one about the elevators. Then my computer had some issues, had to reset the factory settings. Wasn't thinking. Wasn't thinking. So I reset everything is cool. And I went to go get into that account and like, oh man. Like so that account's out there until I figure out what email address I use and all that kind of stuff, man. So I'm like, all right, I'm just gonna post them on I Really Want to Know podcast. So I'm learning as I go, guys. This is the beauty of being retired. You get to learn stuff if you want, man. So I'm out here trying to learn some stuff, trying to do some things. Um, so yeah, we got that. We have the Red Pill Lens, like that. That YouTube channel was doing this thing where I put out faceless stuff on red pill topics, bro, like hypergamy, the Disney fairy tale. We talk about the family law trap. We talk about dating in today's market. We talk about how simpletons have changed the game, passport bros. I drop a video every Monday over there. I just do the videos, I put them out, and I'm all the way up through February. I'm working on the first episode for week 1 of March. So check it out. I will probably pull one of those up today. We'll just watch the whole video on this platform, man. Check it out. Go over there, support, watch. I mean, for the red pillars, man, this is what y'all want, man. This is the stuff, putting it out there from from an old head's perspective. And what else? What else we got going on? Just about to really go hard in 2026 with stand up. So you guys are gonna start seeing some content around that. I might just have some behind the scenes footage or me doing open mics, maybe me working with people. We're gonna definitely be promoting some producing and promoting shows this year. So behind the scenes with that. So just be prepared for a whole lot of content. Some IRL stuff that's gonna be going on when we're just having conversations with folks. We're gonna be just doing interviews, kind of like Vlad TV style interviews where it'll just be me behind the camera interviewing whoever's sitting in front of the camera talking about stuff. We're going hard in 2026, guys. I got some other stuff that's brewing that I'm not quite ready to reveal, but working hard. Working hard. We got Brother Mandrill in the building. What is good, fam? So glad you're here. Mandrill's like, I haven't heard much about the housing market lately. I'm looking forward to this one. Bro, you're gonna get a kick out of it, man. And the people, the platforms that I watch, that's all they talk about. This is one of the few platforms that talks about everything. That's one of the reasons why the algorithm doesn't know what to do with me. I mean, definitely the red pill stuff has something to do with it, but I think it's because the content is everywhere. The algorithm just doesn't know how to push it. But the people we're gonna be watching EchoFin and Reventure Consulting, like Reventure, they talk about this. Bro, what's going on with the Wall Street money? What's going on with Blackstone? What's going on with interest rates, bro? I think you're really gonna get a kick out of it. Definitely, Brother Michael's in the building. What's happening, fam? Good evening to you. Yeah, no hair has the helmet hooligans and the makeup, bro. Yeah, talking about these women out here. Bro, I don't know if you've noticed or not, man, but women are listening, bro. Like women are listening to the message and they're starting to tone it down a bit. I'm not talking about the chicken heads and the hood rats. You know what I mean? The trailer park princesses. I ain't talking about them. But the average woman who is just trying to figure it out or just kind of maneuver out here in these trenches, I'm starting to see that not as much makeup, bro. I'm starting to see the big, those big eyelash things kind of go away. So I don't know. I think it's good. I think it's good, man. He said, don't become a stepdad, boy. The crash test done. Hey, man, listen. If you want to make that move, if you want to be a stepfather, that's fine. I suggest you check out Through the Red Pill Lens when we talk about that, the family law trap. You know what I mean? I talk about that. A lot of guys think, well, I'm not biological. I ain't got nothing to worry about. Bro, you got something to think about because you can get caught up in there. So that's that. I think, man, I'm sitting here. I believe I'm forgetting something, but, that's just being old. Y'all know what it is. So let's move on to this, man. We're going to start with EconoFin, bro. This is, if you guys haven't checked them out, they're in the description below. At the very end of all that stuff, we got the description right there towards the end. Like that last few lines, it's a link to them and Reventure Consulting. Definitely click on that and subscribe to this channel. We're gonna listen to what they're talking about, bro. We're gonna listen to what they're talking about. I hear you, brother. I hear you. Like, well, I would rather be a mark instead of a step crash dummy. All right, bro. I hear you. So let's pull this up. We're going to check out this video, man. And remember, guys, I've been following these people for a long time. George Gammon and some others have been talking about this. This has been a long time in coming. There was no way to avoid this. And I'm not saying it's here, but we're definitely in the outer bands of the, housing. Let's call it the housing market hurricane that's about to crash into us, where we're just like the outer bands that we're experiencing right now. So let's check this out.
While everyone's been focused on individual homeowners losing equity, there's a much bigger story happening at Wall Street's most powerful private equity firm. The massive $1.8 billion senior house gamble, a bet that began in 2016 when demographic trends looked unstoppable, is now collapsing in spectacular fashion. But this isn't just about senior housing. As you'll see in this video, Blackstone's real estate crisis is sending shockwaves through the entire housing market, affecting single-family home prices, institutional buying patterns, and creating opportunities for regular home buyers that haven't existed since 2012. And according to the Wall Street Journal's explosive new investigation, we're witnessing what industry insiders are calling one of Blackstone's worst investments in recent years. But here's what makes this different from anything we've seen before. According to the Wall Street Journal's detailed analysis published in November 2025, Blackstone is liquidating 90 senior housing properties with confirmed losses exceeding $600 million.
Bro, y'all see that? Blackstone is offloading. Again, this is according to the Wall Street Journal, guys. So this isn't like, Bubba's YouTube channel when he's out here talking, man. This is the Wall Street Journal. Blackstone is offloading a flop $1.8 billion investment in senior housing. And think about all of the housing that Blackstone is invested in. They're just talking about senior housing right here. Senior housing. $1.8 billion, bro. Right? They're selling off about 90 properties, in some cases at over a 70% below their purchase price. So, like I said, the outer bands are here. Right. So will Blackstone be able to, eat these losses? Or will they force the bank or whatever lending institution that gave them this money in the first place to take the haircut? Or does it go to their investors and those people who are running those retirement funds and stuff like that? This is what I'm talking about, bro. This is the beginning. These are the first few dominoes that are going to fall. And bro, once it begins, man, it ain't no stopping it until it runs its course.
That's the highest share of portfolio losses since Blackstone's founding. But when you dig deeper into whose money was used to fund these declining properties, a disturbing pattern emerges. The pension funds that invested in Blackstone's real estate partner 8 fund, money belonging to teachers, firefighters, and government workers, are now sitting on what industry insiders are calling the most devastating institutional wealth destruction since 2008.
Damn.
Let me break down exactly what's happening here because the numbers are staggering. In 2016 and 2017, Blackstone went on an unprecedented senior housing buying spree. They acquired 64 properties from HCP for $1.1 billion in 2016, then grabbed another portfolio from Welltower for $747 million in 2017. They weren't just buying a few facilities here and there. They were acquiring entire senior living networks, totaling 9,000 units across the country.
Man, 9,000 units, bro. When I first listened to this, I'm thinking like, what are they talking about here? They're not talking about, just like one of those small companies that work out of like a residential home front type of thing. Like, nah, bro, they're buying up like the old folks, the whole kit and caboodle. They're buying like the facilities, the associate facilities. They're like the mental stuff, the medical stuff, the transportation. They're buying it all. And they get 9,000 units across the country. And I don't think they mean like doors. Like they mean like proper, like units. Like just the whole, like I had one of my aunts was like in assisted living. Like they're buying like the whole plantation type joint. That's what they were buying. And back then, it probably seemed like a really strong investment considering what the interest, like what the Fed rate was. It's like, oh, this is a great place to park the money. The returns were better than they would be able to get through, T-bills and all that kind of stuff and treasuries or whatnot. So maybe it was, like, all right, that's a good idea. But have things changed? Times have definitely changed.
And here's where it gets interesting. According to the Wall Street Journal analysis, Blackstone paid an average premium believing the aging baby boomer wave would guarantee returns. These same properties, based on recent sale data, they're now selling for 29 to 75% below purchase price. That's a minimum $219 million loss per the Wall Street Journal's analysis of just 39 properties, before we even factor in the $100 million Blackstone spent on property improvements, insurance, and maintenance. Do the math with me here. 39 properties sold for $536 million that were purchased for $755 million equals $219 million in immediate losses. And that's just 39 of the 90 properties. When you project this across the entire portfolio, we're looking at over $600 million in confirmed wealth destruction. And that's just what we know so far. But wait, it gets worse. Much worse. Blackstone didn't just pay cash for these properties. They leveraged their purchases heavily, borrowing $1.2 billion in floating rate debt to finance this buying spree.
See, that's what I'm talking about right there, bro. Who backed these loans? Like, what institution was it? Was it a regional bank, mid-sized bank? Was it a too big to fail bank? I'm hoping it was a too big to fail bank, because this will destroy a medium-sized bank. This will destroy a regional bank. We know a credit union didn't do it. So who's going to take this haircut? The bank. And we're talking about one company. This is Blackstone. We're not talking about all the other companies that were doing the same thing.
When interest rates started rising in 2022, their loan payments ballooned and cash flow evaporated. According to the Wall Street Journal, 24 of these properties went into special servicing, Wall Street's polite term for "we're about to default on our loans." But here's the part that should terrify anyone with a pension or retirement fund. The institutional money that Blackstone used for this senior housing disaster wasn't just from billionaire investors. According to SEC filings reviewed by the Wall Street Journal, major pension funds, including the Arizona Retirement System, $100 million. San Francisco Employees Retirement System, $150 million. North Carolina Retirement System, $200 million. And Pennsylvania Public School Employees Retirement System, $300 million. All invested directly in Blackstone's Real Estate Partners 8 fund that bought these properties.
Bro, did y'all see all that, man? Did y'all see all that? Ooh, they are going to take a haircut. Arizona Retirement System, man. There's a lot of people, just regular folks, man, pulled their money together, man, and whoever's managing these portfolios sank their money in with BlackRock, right? San Francisco and Employees Retirement System. Like this, the San Francisco Employees Retirement System, man, $150 billion. Bro, damn. North Carolina Retirement System's caught up in this. Pennsylvania Public Schools Employees Retirement System. See, this is the problem, because if everything goes sideways, the government is going to have to step in. The government is going to step in, but I'm telling you now, there's not going to be any bailouts. So what happens? Will the government step in and make the people in these retirement systems whole, or will they step in and come up with some sort of way to get money to Blackstone and the Wall Street people? What do y'all think's going to happen?
Blackstone's Real Estate Partners 8 fund that bought these properties. Arizona teachers alone put $100 million into this fund.
Damn.
Pennsylvania school employees invested $300 million. These aren't small positions. They represent meaningful portions of retirement assets for hundreds of thousands of Americans who trusted Blackstone with their future. And now, according to the latest pension fund disclosures, these allocations are showing negative returns for the first time since the 2009 financial crisis. The Arizona Retirement System recently reported significant headwinds in their real estate investments, while Pennsylvania teachers are seeing their Blackstone allocation underwater for the first time in over a decade. Now, here's where the WSJ data becomes absolutely critical. The specific properties where pension fund money was concentrated are exactly the facilities showing the steepest declines. South Carolina, Florida, Colorado, Illinois. These were Blackstone's senior housing darlings during the buying spree. And according to the WSJ investigation, these are now the epicenters of the institutional wealth destruction. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like.
Definitely support them. Like, subscribe. Again, their link is in the description below.
Keep making you great content. Thank you. Now, let's keep going. Take Florida, for example. The WSJ reports that Blackstone's Aventura property was purchased for $48.8 million, but sold for 75% less after regulators found inadequate resident care, unsanitary conditions, and administrative failures.
You see, that's huge. Because when times are good, the money is flowing, they just buy it. They're like, man, they're doing their due diligence. They're looking into it, but they're just looking at the numbers. They're not looking at, okay, what are you supposed to be providing and what's going on with that? They're not sending in their own, inspectors to make sure that everything is golden. So they buy it, they got it. And I guarantee you one thing, bro, I'm willing to bet anything. I'm willing to bet $1 to a donut, man, actually, I probably have to bet $10 to a donut. The cost of donuts, man, they've gone up. Bro, my daughter wanted to stop and get donuts the other day, man. Like, it was like $15 for some glazed and chocolate donuts and some donut holes, bro. Anyway, let me get back to that later. I bet you that Blackstone got out of this because of insurance reasons, not just the medical insurance. I'm like, just to insure the whole property because of the problems that are going on down here in Florida. I wouldn't be surprised if that was the reason they did it. But you also don't want to be left on a hook for malpractice. Down here in Florida, man, like old people with dementia, they get away from, these assisted living facilities or these old folks homes. They get away all the time, man. And sometimes they get like eaten by alligators. Like sometimes it happens. Like they just start wandering. They're out. They see some water. Ooh, the water is nice. And then like some alligator comes out and snatches them up, bro. It happens, which is crazy down here, bro. Or they just can't find the old person. They don't know where they went. They'll just be out roaming around and won't, people got to go out and try to find them. You don't want to, if Blackstone is tied into this, they own the property, then, those grieving families are going to come for them. So that's, they're going to get rid of these properties, man. It's crazy. And if I make a mistake and say BlackRock a couple times, please forgive me. Y'all know I'm old.
That's not just a bad investment. That's a regulatory nightmare that destroyed tens of millions in pension fund value. Let me get more specific about the facility level carnage. In Greenville, South Carolina, Blackstone's senior housing facility saw occupancy collapse from 80% to just 41% during the pandemic. The Wall Street Journal reports this property was recently sold for 60% below purchase price. But here's the truly disturbing part. The Centers for Medicare and Medicaid Services gave this facility a 1-star rating after investigators found it incorrectly prescribed antipsychotic medication to a resident in a way that was likely to cause serious injury, serious harm, serious impairment, or death. Denver and Chicago tell similar horror stories. The Wall Street Journal found that Blackstone sold properties in these metro areas for 70% less than they paid. We're talking about facilities that were supposed to provide care for America's elderly, funded by America's workers, now being liquidated at devastating losses because of operational failures and regulatory violations. American seniors weren't getting the care they paid for, and American workers are losing their retirement savings in the process. And this should really concern you. Blackstone isn't a mom and pop operator who can just sit tight and wait for the market to recover. They manage $1.2 trillion in assets with shareholders, fee obligations, and quarterly performance targets. When a $1.8 billion bet goes wrong this badly, they're forced to cut their losses rather than double down on failure. And the pressure is building from multiple directions simultaneously. The $1.2 billion in floating rate debt that Blackstone used to buy these properties is now crushing their cash flow as interest rates have risen from near zero to over 5%. According to the WSJ, loan payments ballooned and squeezed cash flow further until 24 properties had their loans transferred to special servicing. But here's why this senior housing collapse.
And again, special servicing for those people at that level means the corporation understands that they're not going to be able to pay back the loan under the current terms. Let's go in here and try to work something out. That's what that is. And even the bank or the lending institution realizes like, we got to try to work something out, but they see the writing on the wall. Like, all right, these people are about to lose it. So let's work with them so they don't just walk away. And you got to understand like the biggest problem with these companies is the interest rate in which they borrowed the lump sum of money. And this is what George Gammon was talking about this 3 years ago when he was talking about California problems, when he was talking about, Silicon Valley Bank and all that. George Gammon was talking about this 3 years ago. He's like, these people borrowed all this money at real low interest rates. You're looking at 3% or lower. Let's say 4% or lower. So think about that. You borrow $500 million at 3.5%. And it's time to reservice that loan, and you can't get a loan for less than 7%. Think about that, because all the banks and lending institutions are like, yeah, y'all are over leveraged. Everything's messed up. All your money, all your income is tied to the market, and the market is turning. And they're like, well, when this thing comes in, you're gonna go from 3.5% to 7.5, 8, 8.25. They can't do it. They can't. That's the problem. It ain't just like one or two outliers. Nah, the one or two outliers are the ones who didn't borrow as much or even went at a slightly higher interest rate because they're thinking like we got to project into the future. This is why you heard all that talk about, Trump and, a lot of the one percenters. We got to get interest rates down. We got to get interest rates down. we got to get we got to get Jerome Powell to lower the interest rates, but we still got a problem with inflation. If you lower the interest rates, inflation goes up. That's just how it works. They can't lower the interest rates. And some people say, well, the banks are giving lower interest rates. Yeah, because the banks knows what's coming. Right? They're trying to work their books. So, bro, this is a problem, bro. This is a problem, man. I mean, this is crazy, brother Mandrell. He's like, I know, right? A dozen donuts, it cost him about $15. He's like, I love my Krispy Kreme, bro. That's crazy, man. Them donuts, man. Brother Pitney in the building. What's happening, fam? Yeah, they have been making bad calls, man. Blackstone's been making bad calls for a minute. Their flagship real estate trust, in late 2022, dealt a serious redemption issues. Investors are barred from pulling their money out. I remember that, bro. I remember that. And it wasn't just them. I think a couple other companies did the same thing, which really scared and shook the market for a hot second, man. But then the market started climbing again. But this is the kind of stuff, man, that people either don't have time to look at or just inundated with other news. Like everyone's talking about Greenland right now. Everybody's talking about Davos right now. Everyone's talking about Cuba. Everyone's talking about, Venezuela. Everyone's talking about, Mexico, maybe Colombia. So much going on. No one's looking out the back window and seeing what's going on right here in the good old US of A.
Should terrify every homeowner and potential buyer. Blackstone isn't just a senior housing investor. They're the world's largest owner of single-family rental homes through their subsidiary Invitation Homes.
That's right.
The $600 million loss in senior housing is forcing Blackstone to reassess risk across their entire $71 billion real estate portfolio, including over 80,000 single-family homes they rent to regular families. According to industry sources, Blackstone is now tightening lending standards and reducing acquisition targets across all real estate sectors, not just senior housing. When the most aggressive institutional buyer in America starts pulling back, it creates ripple effects through the entire housing ecosystem. And here's the connection most people are missing. The same floating rate debt strategy that destroyed Blackstone's senior housing returns is used throughout their residential portfolio. As interest rates continue rising, Blackstone is facing similar cash flow squeezes on thousands of single-family homes they bought during the pandemic peak. Properties they purchased for $400,000 to $500,000 in 2021 and 22 are now generating negative cash flow as their debt service costs have doubled.
This is what we were talking about with the, that interest rate that low interest rate they had on that bundle of money that they used to buy and upgrade, not even upgrade, but just, get these houses up to code, new roofs or whatever they had to do. And the one thing that they didn't even mention is the properties that they bought for $400,000 and $500,000 back in 2021 and 2022. They're not going to be able to sell at $400,000 and $500,000 today. They're not. They're going to have to slash prices. So it's just like, man, like the investment itself has lost money along with all the associated costs. This is a bad thing, bro. And I'm surprised that mainstream media isn't talking about it. But then again, there's so much going on. I guess the news people can only fit in so much news.
This means institutional selling pressure isn't limited to senior housing. Blackstone and other private equity firms are quietly beginning to list single-family homes in markets where their purchase prices no longer make financial sense. Phoenix, Austin, Tampa, Charlotte, the same metros where institutional buyers drove up home prices during the pandemic, are now seeing increased inventory as these firms try to limit their losses. For regular home buyers, this creates both opportunity and risk. Opportunity because institutional selling increases inventory and reduces competition. Risk because when $2 trillion in institutional money starts reassessing real estate exposure, it can trigger broader market corrections that affect everyone's home values. The pension fund losses we're seeing in Blackstone's senior housing disaster also reduce consumer spending power. When teachers in Arizona lose retirement money and firefighters in Pennsylvania see their pensions decline, they spend less on housing, cars, and everything else. This demand destruction can accelerate housing market weakness beyond just institutional selling pressure. Meanwhile, state and federal regulators are cracking down on senior housing operators with poor safety records. When Medicare gives your facility a 1-star rating and state investigators find medication errors that could kill residents, your property value doesn't just decline, it becomes a liability that must be sold immediately. And we're already seeing the institutional liquidation accelerate. Blackstone has already sold 70 of their 90 senior housing properties and is in talks to sell the remaining facilities, according to the Wall Street Journal. Industry insiders know this is code for, we need to exit this disaster before investors demand answers. The firm has suspended any new senior housing acquisitions and quietly removed senior housing from their target investment categories. Now, here's the part that affects the broader senior housing market.
I mean, bro, if y'all listen to all this, man, this is insane. what they're saying right here, bro. This is crazy. Man.
Houston, we have a problem.
That's what this is. Houston, we got a real problem here. Because they're gonna get rid of everything. They don't care at what cost, they're gonna get it off their books. I mean, someone's getting a hot potato, or they're gonna walk away from it and the bank is stuck with it. And then these poor people they're paying their money to get these resources, to get these services through, these assisted living or old folks, like facilities, hospice and all that. Man, this is a problem. This is a problem. So now America is really relying on AI because housing was driving everything. And now we see that that's a problem. Let's watch just a little bit more and we'll switch gears here.
When the world's largest alternative asset manager starts dumping an entire asset class at massive losses, it sends shockwaves through the entire industry. Suddenly, a market that pension funds thought was a safe demographic play based on aging baby boomers becomes a cautionary tale about operational complexity. And according to industry data, we're already seeing this play out. Senior housing construction financing has become more expensive as lenders now view the sector as higher risk. Insurance companies are demanding higher premiums for senior housing operators. Even well-run facilities are seeing their valuations decline simply because Blackstone's failure has spooked institutional investors. This explains why other major players are stepping back from the sector. KKR recently announced they're reducing senior housing exposure. Apollo has suspended new senior housing investments. The institutional money that was supposed to solve America's senior housing shortage is now fleeing the sector entirely. What's happening is that Blackstone's spectacular failure is creating a crisis of confidence that extends far beyond just their portfolio. When the most sophisticated investors on Wall Street can lose $600 million this badly, it makes everyone question whether senior housing is really the demographic goldmine it appeared to be. And this is where the story takes an even darker turn for pension funds. Many of these pension fund investments were marketed as conservative, diversified real estate plays that would benefit from predictable demographic trends. Aging baby boomers need senior housing. How could this investment possibly fail? Pension fund managers sold their boards on this logic when committing hundreds of millions in teacher and firefighter retirement money. But according to the WSJ investigation, Blackstone's operational failures reveal that senior housing isn't just real estate, it's healthcare, hospitality, and housing all rolled into one complex business. As one industry insider told the Journal, you're buying an apartment inside of a hotel, inside of a restaurant, inside of a medical clinic. That's a good way to put it.
Bro, if all that collapses, man, think of all the people who are out of work. Never mind the poor people who are paying for the services. Like, what's going to happen to grandma and grandpa? They got to go back home. Their kids got to take care of them. If they have kids, their family's going to have to put them in a house somewhere, like with them, and try to provide this care. Or cough up more money, because once the places start to close, the places that survive, the top tier joints, they're going to just raise their prices. So this could be the beginning. Like I said, this is just the outer bands, bro. Not could be. This is the beginning of this nasty, housing hurricane that's just about to crash into us. So that video was pretty much all about what's going on with the senior living play that, Blackstone invested in. It's not just Blackstone, there's other institutional investors invested in that too, because they're thinking like, oh yeah, the baby boomers, they're going to need this. This is the perfect play. There's no way we can lose. Whenever someone comes to you and say something like that, there's no way you can lose. Be careful. Be careful. So we're going to switch gears, man. We want to talk about what's going on for just regular folks, man. Reventure Consulting. This brother right here does an excellent job. We're about to check him out. And he goes around the whole country. I want to say he's based out of Florida, Central Florida, if I'm not mistaken, but he goes all over the country and he just kind of looks at what's going on in the market. And, he does his videos. He, walks around with, the selfie stick and his camera on the end of it and talks about what he talks about. And he goes to places that he really knows. Like he knows the areas, he knows what he's talking about. He knows about the builders and what they're doing. And he kind of looks at listings so we can see in real time what's going on. So let's definitely check this out, guys. And again, go back and watch the rest of EconoFin's video. And they post stuff like multiple times a day. Go check out their channel, their content. They got some good stuff in there. So, and again, that's in the description below. And also Reventure app, Reventure Counseling. I think that's what its official title is. But I always say Reventure app because they have an app that tracks all of the housing markets throughout America. It's a really good app. He built that thing. He put it out there. Of course, he charges for it, but if you're looking for a house, it's definitely worth the investment. It's not like crazy. It's a month-to-month kind of thing. Just use it while you're doing your research, and then when you find your home, you're ready to make your move, just go ahead and, you can stop if you want to. But Reventure app is probably how I'm going to refer to him. But let's check out what he's talking about.
Folks, these landlords are starting to go into default on their mortgages. Many of these buildings are we have seen on the U.S. housing market in 15 years, according to CoStar, going back to the end of the last housing crash. Buildings like these are now cutting rents, as a lot of them have high vacancy. And this is a signal of housing market deflation. We're seeing a decline in rents and a decline in prices in many houses across America. I think that we could even see bigger drops in 2026. And in particular, folks, some of the markets with the biggest rent declines include Austin, Texas, down 21% in rents. Fort Myers, down 18% in rents.
Hey, they got Lakeland, Florida on that list. Number 10, Lakeland, Florida. That's right here, y'all. Lakeland, that's just 20 minutes north of where I am, bro.
Colorado Springs, down 15%. Phoenix, Arizona, down 14%. Northport, Sarasota, Florida, down 14%. And that's just the start of it. Double-digit rent declines since the middle of 2022. And that's a great win for renters in America. Renters are finding more affordability, but it's a big problem for landlords because we're starting to see a lot of these landlords now go into default on their mortgages. They took out these cheap mortgages in 2019, 2020, 2021 when the rates were low. They built these apartment buildings, and now some of them can't service the debt because the rents are falling. According to Freddie Mac and Fannie Mae's mortgage default survey, we have the highest mortgage defaults for multifamily that we've seen since the last crash. You can see it's going vertical. It's not a huge rate overall. It's around less than 1%, but it's the highest that we've seen since the last crash. In addition, CMBS multifamily mortgages are seeing surges in default as well. And some people I know who are active in buying in the multifamily space, they are seeing those in foreclosures all over the place. Now, I think the mistake that some people are making in the housing market is that they're looking at these declines for apartments and multifamily, and they're thinking that it's not going to spread to single family. They think it's going to stay isolated. The issue is, though, when rents drop, if your rents are dropping, why would you become a first-time buyer? If your landlord's giving you a deal to renew your lease, if a new apartment's giving you 3 months free or 2 months free, you're going to stay as a renter, especially when home prices are very overvalued.
And what he is talking about is true, man. I'm always talking about this thing. And I think what people fail to take into account is how long it takes for these changes to hit. Think of it as like a big train. It's a really long train. When the turn begins, it takes a while for you to hit that actual bend, depending on where you are in the train. I like to consider myself like I'm in the front of the train. So it started turning right away. I'm like, yeah, I'm right up here. I'm right up front. But everybody else is like in the middle and towards the back. They're like, man, what you talking about, bro? Ain't no, everything's going smooth. We're still smooth sailing. We're going the way we're supposed to be going because they haven't hit that turn yet. Oh, but it's coming. Right? That turn is coming. And what he was saying about rents, I was talking to some people of mine a couple months ago, and they're like, oh, man, rents are up, and, they're going to continue to go up. I'm like, what are you talking about, bro? Like, rents are down. Like, here in like Tampa, the Tampa area, about 6 to 8 months ago, rents began to plateau. They were here before this. So they kind of leveled out and started to plateau, and now you're starting to see a slight decline. Why? Because these brand new big properties, just like he's talking about, these huge, really nice properties are empty. And whenever I drive through Tampa, billboard, people holding sign, those human directionals, I think that's what they're called. They're holding signs. Bro, it's all kind of deals in these places, bro. They want to get you in here. Come on over here. They're offering like crazy deals because they're at maybe 25, maybe 30% occupancy, bro. I mean, 70% of the building is empty. And they owe all that money. And that money that they borrowed way back when, that debt it's time to resurface that debt. And they're not even bringing in the bread. Like, so it's a problem. Let's continue.
I'm actually standing right now in Dallas, Texas, near the center of Dallas, Texas. This is a very high-end area, but even in Dallas and DFW, rents are going down. According to data from Apartment List in Dallas-Fort Worth, rents are down 10% since the peak of the 2022 rental bubble, and they could drop by more because the vacancies are going up. But as always, folks, it's a bifurcated market. This apartment property in front of me here in Uptown in Dallas,
older,
just to the east of the Katy Trail, which is over there, you could get a 1-bedroom here for around $850 a month. And you can get a 2-bedroom for $1,200 a month. So that's $600 a bedroom to live in a great neighborhood here in the center of Dallas, showing you that these rent declines, they're happening all over the place. Some people say to me, oh, Nick, you just go to rural and suburban areas with home builders, and that's the only area that's going down. They say, no, folks, even in the city centers, the prices and the rents are dropping. It's happening in Nashville where I live. It's also happening here in Dallas. There's no way 2 or 3 years ago you could have gotten a 1-bedroom for $880 a month. However,
now, the property he's talking about, we can't see it. I think he might show some highlights of that apartment, but that's an older building, right? It's just down the street from the new builds. It doesn't have like all of the brand new amenities and all that kind of stuff that the other building offers. But who cares, bro? You're looking at it like, hey, man, $850 for a 1-bedroom, done. And it looks like it probably has underground parking. Right, that's what I'm thinking. So it ain't that old. It's not like it's a mom and pop where you're just looking at like a 4-unit or a 6-unit. It's still a pretty big building. It probably has. I mean, I'm just guessing here, but it's probably got more than 50 units in there, right? Versus the 200-300 unit high rise down the street. But don't nobody care about the amenities and all that kind of stuff, man. It was like $850 for a 1-bedroom. It's probably cozy, I don't know the square footage, I forget what the square footage was, but it's going to be less than 1,000 square feet, but that's fine. Nice little cozy spot in a good neighborhood. Why wouldn't you take that, bro? Why wouldn't you take that? And again, these are the units. These are the people who are in the front of the train. They see what's going on right now. They're in the trenches. Everyone else is in the middle and the back of the train. They don't really see it. Again, that's why I keep saying these are the outer bands of this housing hurricane that's coming right at us.
The market is still bifurcated because literally just across the street from this apartment is another building where the 1-bedrooms are $2,800 a month and the 2-bedrooms are over $4,000. And when you go on Zillow, this building here has over 100 vacant units, and they're offering 8 weeks free on rent, which is 2 months free. On a 12-month lease, that'd be a 16% rental discount. And this bifurcation exists all across the U.S. housing market, where it seems like the wealthier the people are and the wealthier the area is, the more it's holding on. Or, maybe the more low income the people in the renter and the homeowners are, the more low income the area is, the more it's going down. And you could see this very clearly in Dallas's housing market. If you go to an area like Highland Park, which is just about 5 miles north of downtown Dallas, this is one of the richest areas in Texas. Homes on the market for $20 million. Home prices are still going up there. According to data on Reventure app, home values in Highland Park, the bougiest area of Dallas, it's the Beverly Hills of Dallas, is up, 3 to 5% year over year. And we're forecasting continued increases due to the fact that the inventory in these luxury zip codes is still really low. However, when you go pretty much anywhere else in Dallas, values are going down. And when you go kind of to the lower income zip codes to the south of Dallas, values are down almost 10% year over year. And so this is a perfect example, an analogy of what's happening in the economy. It's called the K-shaped economy. And it essentially says that the wealthier are continuing to get wealthier, and those who are more low income are continuing to be low income.
The have yachts and the have nots. Come on, let's keep it 100, fam. The have yachts and the have nots. The have yachts are doing good. They have money. Why would their property value suffer? Everyone's going to want to live in the Beverly Hills of Dallas or the Beverly Hills of Tampa, like High Park area down here, or the Beverly Hills of Cincinnati, like West Chase or actually High Park in Cincinnati too is really nice. I ain't been home in like decades, but like Westchester out there, Sycamore Township or whatever in Cincinnati, or the Beverly Hills of Beverly Hills. Like you go out to Cali, people are going to want to live in Beverly Hills. People are going to live in Bel Air. They're going to want to live, you know, I mean, as close as they can to Malibu, although, you know, a lot of Malibu burned down in the fire. But the people who have the money, they don't have to worry about their real estate property values dropping out. But everyone else does. Why? Because the correction is here. Those properties that are outside of the nice areas were overpriced, period. And they're going to correct down to where they should have been in the first place. And it's going to be like so you got like the cool areas, not the Beverly Hills, but the Beverly Hills adjacent, like the nice, cool, hip places, they're going to adjust down. And then where the normal folks live, that's really going to be an adjustment. So if you're paying $850 for a 1-bedroom in the Beverly Hills adjacent, like the nice neighborhood, how much you think that 1-bedroom is going to cost you hood adjacent? Right? It's going to be at least $200 less. Right? I mean, at least you're going to find yourself some good deals. And then when you get into the mom and pops, the 4-unit, the 6 units, you know what I mean? When you start getting into that, bro, those prices are going to come down. And that's what we're dealing with right now. And this is just the beginning. No one knows how deep this correction is going to be, but it's going to be a reflection of how much people make. Right? If the average American household is only bringing in $80,000 a year, bro, that housing correction is going to have to come down to meet their financial ability to purchase a condo or to purchase a rental or whatever. Let's continue.
And might even be going backwards. And we're just seeing that in the home values across the DFW market. However, we are seeing condo prices go down here, everyone. Condos are available. And when I go on Zillow, I'm seeing $100,000 price cuts on condos and townhouses all around Dallas. Yesterday, I was filming up in Addison, Texas, about 10 miles to the north of here. I found a townhouse, 2-bed, 2-bath for $205,000. Wow. Pretty cheap price. They've cut it over $100,000. It's still on the market. In this property here, everyone, there's a condo where the owners cut the price by over $100,000. It was $485,000. Now it's down to $385,000. Nice looking 2-bedroom condo. Current list price of $385,000 is actually $100,000 less than it was listed for in 2017. So we're below pre-pandemic valuations on some of these condo and townhome units. A lot of people have no idea that this is happening, but it's happening in real time. And one reason why is the HOA fees. The HOA fees on some of these units are absolutely absurd. The one I just showed you has an $1,100 a month HOA fee. Who can afford that, especially when you can rent the 1-bedroom around the corner for $900 a month? So, you know, we're seeing...
Bro, hold up. Did y'all hear that HOA fee? In Texas? Are they high? What do you think? In Texas, the HOA thing is a problem down here in Florida for whatever reason. I mean, for basically mismanagement of these HOAs. And you have special assessments. That building fell down in Surfside or wherever that was. The building fell down. So that's the fallout, from that. But why would the association be so high in Dallas? That's insane. So no one's going to do... Bro, if you can go and get you a brand new apartment somewhere with all these amenities, why would you buy right now? It's like, bro, I'm not paying that association fee. The association fee is like probably might be more than the mortgage. Like I'm gonna sell you the house for $200,000, but you have to pay this association fee. Damn. Bro, we gotta hear that again.
HOA fee, who can afford that, especially when you can rent a one-bedroom around to $385,000. Look, in two-bedroom condo, current list price of $385,000 is actually $100,000 less than it was listed for in 2017. So we're below pre-pandemic valuations on some of these condo and townhome units. A lot of people have no idea that this is happening, but it's happening in real time. And one reason why is the HOA fees. The HOA fees in some of these units are absolutely absurd. The one I just showed you has an $1,100 a month HOA fee.
$1,100 on top of your mortgage. $1,100 on, bro. I mean, Brother Peter, you out there? How much would the mortgage be on what was it? 285 or whatever that was? How much would the mortgage be on $250,000, a 30-year fix, with 20% down? Bro, the HOA fee might be more than the mortgage. And if it's not, it's real close. It's real close. Depending on the interest rate right now, I think you're getting sub 6% on the interest rates. So you probably, let's say you got perfect credit going there, you probably get your interest rate at maybe 5.25%, right? $250,000 at 5.25% over 30 years. My goodness, man. So no one's gonna buy, bro. No one's gonna buy. And I always put Brother Pitney on the spot because that's like the keeper of the knowledge. I'm like, hey, man, he might be driving or something, but that's like, just do the math, guys. You look at a house, if you can buy your house for $250,000, nice condo, townhouse, or something like that for $250,000, and then add another $1,000 on top of that for association, bro, it's not worth doing. That house, that property now has to come down to $125,000 before you even consider it. Like, nah, you're gonna have to lower that price, bro. I'm talking about this $1,100, $1,100, $1,300, $1,500 association. Down here in Florida in the condo market, that's the killer of all these deals. You go ahead, you're like, oh man, I got this person wanting to sell me this condo for $225,000, $200,000, $175,000 up here in Central Florida. But you're looking at association of like $1,800, $2,000. Down in Miami, there's some associations up there, bro, like $2,500. Like, damn. And it's like, oh, because of the assessments and all this other kind of shit. Like, well, where's it gonna level out when the assessment's paid off? Right. So it's man, this is just the beginning, guys.
Who can afford that, especially when you can rent a one-bedroom around the corner for $900 a month? So, we're seeing an existential crisis in the condo market in America right now, where even though the condo values are dropping, even though the Wall Street Journal is saying it's the worst condo market since 2012, we're not seeing the buyers come back in. And the buyers aren't coming back in because they don't want to pay these crazy high HOAs and ultimately pay a cost to live in a condo or townhome that's going to be 50% more than if they were to rent the same thing. And uptown in Dallas is kind of a fun neighborhood. It's a mixture of architecture. You got kind of these older pink kind of like 1950s, 60s looking units here that almost look like they could be in New Orleans. But then you got these more high-rise units in the back, some that are newer, some that are older. They just cleared this lot here. I suspect they're going to probably put something on this lot right behind me. And we got some for lease signs, more condos and townhomes on the market for rent. These declines in rents are a huge deal. It signals deflation in the market. It signals a higher likelihood that prices and rents go down across the entire market. And it's happening because the builders built a huge pipeline of apartment units. I mean, the apartment developers and the builders went absolutely wild during the pandemic. We had a peak of 2 million homes under construction. That's gone down a bit. We now have about 1.3, 1.4 million homes under construction. Still a big pipeline coming in 2026. We talked about how Austin, Fort Myers, Colorado Springs, Phoenix, and Northport were at the top of the rent declines list. Additionally, you got Raleigh, San Antonio, Atlanta, Denver, and Lakeland, Florida, as well as Orlando, Florida, Salt Lake City, Utah, all down 10% or more on apartment rents, according to Apartment List, from August 2022 to December 2025. In addition, you also have Boise, Jacksonville, and Dallas rounding out the top 15, also declines near 10% on apartment rents. Now, these rents went up a lot during the pandemic, right? So it's not like I'm saying these rents are cheap or that you should run and rent out a second apartment, or if you're living at home, that you should just run out and rent an apartment. But I am saying affordability is returning to the market, and that's good news for you as either a renter or a home buyer. Things are getting cheaper. there's more affordability. And that's just a win all around. We should celebrate that and appreciate that that's actually happening in the Sun Belt in America. However, it's not happening everywhere, folks. Rents aren't going down everywhere. And when I dug into this data, I was actually shocked at how much they're still going up in certain areas too. And to understand this, everyone, I looked at the markets that have had the biggest rental rate increase since before the pandemic. What are the cities where rents are up the most from December 29th?
Bro, before he gets to it, I would guess, I bet you LA's on that list, New York's on that list. And then you probably have some random areas that might be on that list, some like smaller towns somewhere, mid to small towns. But, you know, when you talk about the like what's going on in the housing market, LA and New York are like always their own thing. I always consider them separate. Like you got to talk about them on their own because there's so much wealth out there. And then it depends on what's going on. You know, how many people are moving away from the state versus how many people are moving into the state. I mean, it's like California is still a beautiful place to live, regardless of how you feel about it. Man, that is a great place to live if you can afford it. The things that you can do there, like it's just amazing. Sunsets are beautiful. You got the beach. You can go out to Big Bear. Like you can literally go skiing and surfing in the same day. You got Baja down there, bro. Like you got a lot of great hiking. Just like even in like just the city like of Los Angeles, man, you got like Runyon Canyon, Coldwater Canyon. Like it's just so many places you can go and just walk around. Like it's bro, it's cool. People are a little different, man. It is what it is. It's Hollywood, but it's cool. So it's always going to be a lot of folks want to go out there, and that's going to keep the prices high. And the rental market is going to keep prices high in residential. I mean, it is what it is. But I'm curious to hear who's on his list.
19 to December 2025. Well, number one is Knoxville, Tennessee. In Knoxville, rents are up 48% over the last 6 years. We are not really seeing too much rental deflation in Knoxville quite yet. It's gotten a lot more expensive there. Additionally, in Albuquerque, Toledo, Ohio, and Providence, Rhode Island, rents are also up more than 40% since before the pandemic. And if you look at these markets where rents are up the most in the last 6 years, you can see it's kind of a consistent trend. It's either like a tertiary Sunbelt market that not a lot of people paid attention to, like Greensboro, North Carolina, or Columbia, South Carolina, or it's a Midwest Rust Belt market that absolutely no one pays attention to, like Akron, Ohio, or Grand Rapids, Michigan, or it's like a military area such as Virginia Beach, or a college area like Madison, Wisconsin. Those are the apartment markets that have done the best the last 6 years.
When you look at these numbers, man, like Toledo, they're looking at, was it $913? This is like the average rent cost. Wow. Which is up from $641. Akron. And here's the deal, y'all. I'm a Cincinnati guy. There's nothing going on in Toledo. There's nothing going on in Akron. I've been to both, bro. Like I'm surprised that the cost is this high. There must be industry or something that moved in recently, and that's what caused the bump. I don't even know where the money would come from to pay for this. Wow, that's crazy. That's something we're gonna have to look into.
And the beauty of that is that those are markets that not a lot of apartment developers paid a significant amount of attention to. And what's really bringing down the rents is that construction pipeline. These new buildings like the one behind me, they built so many of them. And now, because the rents went up so much, people can't really afford it. And we're also seeing a decline in aggregate demand. I mean, we should talk about immigration for a second. We all know in 2025 that the immigration has fallen off the table. We probably going to have the lowest immigration in 2025 of any year in the last 4 to 5 decades. It might even go negative. One of the consequences of that is reduced apartment demand. RealPage just came out with some data saying that in the fourth quarter of 2025, apartment demand flipped negative, minus 40,000 on demand, plus 89,000 on supply, which led to even deeper rent cuts in the fourth quarter of 2025. And so long as the Trump administration keeps a lid on the immigration, keeps the border tight, we're probably going to continue to see lackluster apartment demand in 2026, which is going to have the benefit of potentially pushing rents down even further. In fact, according to John Burns Research and Consulting, 100% of the renter demand from 2022 to 2024 was due to immigration. All the renter demand post-pandemic was due to immigration. We could be in a demand vacuum for a couple of years if this low immigration situation stays. So be prepared for that if you're an investor. You know, if you're a landlord or investor, you got to be prepared that we're going through some tough times right now, and that now more than ever, it's important to focus on affordability. Where are the markets where renters have the most affordability? You know, they would be areas where income has outstripped rent growth. And we actually have a data point on Reventure app, everyone, called rent as a percentage of income. And we're looking here at the markets where rents are cheapest relative to income. Number one, actually, folks, is Austin, Texas.
Wow.
Rents in Austin have gone down so much while incomes have kept growing, meaning that the average renter in Austin only needs to pay 18% of their gross income on rent per year.
Like, bro, I'm looking at that list, man. Salt Lake City, Raleigh, North Carolina. You got St. Louis, Minneapolis, Denver, Kansas City, San Antonio, Columbus, Dallas, and Louisville. You ain't gonna find no Florida cities on that list, bro. Right? None. Look at that. So just Texas, Utah, North Carolina, Missouri, Minnesota. Missouri's on there twice. Ohio's on there. Wow. Hey, man, Reventure, if you're out there looking for an apartment, you're looking for a house, a place to live, definitely want to consider Reventure app, guys. If you're out there looking, man, they have some really good data points on there, and they're always updating that app. This is I don't get paid. This is I don't know. Oh boy, like I just watch his content and I appreciate what he does. But if I were looking for a place, I would definitely have a Reventure app. In a couple years when my daughter graduates, I will definitely have Reventure app because I'll be moving to Miami. So I will definitely be using that app, and I'll be using that app probably 6 months before I'm planning to make the move. You know, I mean, maybe a little longer. I probably start like that whole year, actually, to be honest with you. If I know I'm going to move like in January, the January before, I would start looking at the market that I want to live in, start looking at different, you know, data points and stuff like that. And again, I'm not getting paid to say this to you guys. I'm just, I watched them build this app out, and they when they first put it out, they let you just go on there and play around with the app and all that, pause, which I did. I went on there and looked, and bro, I'm telling you, I don't know what the price is, but I'm definitely going to use that app when it's time for me to make my move from Tampa to Miami. I'm going to use that app, and I probably, like I said, I probably start a year out just to kind of watch the market, see which way the market is going, travel down there, see stuff for myself, talk to people. It's a process, guys. And if you want to get the best deal, you know, whether you're renting or buying, man, you got to get down there and talk to the folks. So, anyway, let's get back to it.
Other markets with cheap rents include Salt Lake City, as well as Raleigh, North Carolina. Some of these rental markets with the really cheap rents to income are probably going to bottom soon in terms of rent declines. I would expect in the next 6 to 12 months, we'll probably find a bottom on some of these markets and the rents will stabilize. Conversely, where are the markets where renters are not able to afford the rent the most, and where there's really a tough time, where they're having a tough time affording rent? These are areas you should be more wary investing in as a landlord.
There it is. There's the list. Number one on the list, Miami, Florida, New York, LA. Remember, I was just talking about LA. And looking like the LA area, man, you got Riverside on there. San Diego's all the way down south. Tampa's on the list. I can vouch for that. Boston, Providence, Rhode Island, Fresno, Orlando. That's the top 10. San Francisco is number 11. So you got like New York, California, Florida, right? You got California. And again, like when you're looking at that California market, bro, like all of California is expensive. I don't care where you are, like LA, San Diego, San Francisco, doesn't matter. I don't even care if you're inland, bro. You can be in like shoot. What's in a little bit? Man, I just had it in my mind. I can't think of it right now. But like even if you go like damn, I can't think of it. But you can go out like San Luis Obispo, right? Like that's, you know, on your way to Santa Barbara, you know, in that area. You know, it's bro, I'm telling you, it's crazy how much it costs to live out there. Like it's insane. So even like Riverside County, you know, Orange County, LA County, San Diego County, it just doesn't matter, man. San Bernardino, that's what I was thinking. I couldn't come up with it. San Bernardino. People go out to San Bernardino thinking they're going to get deals. People go to Palmdale. They go to Bakersfield, and they commute from Palmdale to Bakersfield all the way into LA, man. Sometimes it's an hour plus one-way commute to get these better deals. And it's like whatever money you saving, you spending on vehicles and gas and insurance and stuff like that. So it's just the California market and the New York market, I look at them as separate entities. Like what goes on there it's not really the same as what's going on everywhere else. But let's continue.
Landlord, because there is no room really to increase rents any further in these markets. People are stretched. Number one would be Miami. In Miami, the rent to income ratio is almost 40%. The median income in Miami is $82,000. The annual
household
rent that a person needs to pay is close.
Yo, median income, household income. He's not talking about individual income, household income, $82,237,000 household, right? That's insane.
Close to $30,000 a year. So that's 38% rent to income ratio. Folks, in comparison, Austin, Texas is 18% rent to income ratio, and Austin has much better economic growth than Miami does. So, you know, if you're a
but Austin ain't got no beaches, and Miami is Miami, so there's that.
landlord, if you're an investor, if you're someone looking to just decide where you want to live, you know, where do you have better prospects for saving money and getting a job in the future? It's going to be a market like Austin over a market like Miami every day of the week. Other areas with really high to income ratios include New York, Los Angeles, and a lot of places in California. Renters are really strapped there. They're not seeing a ton of relief yet in terms of rent declines because there's a structural housing shortage still in some of these California markets. One thing I would encourage you guys to do is use this data to help yourself as a prospective renter, home buyer, or investor. We have a full suite of investor metrics on ReVenture app that will help you understand the best areas to rent, the best areas to buy investment properties, the areas with the highest cap rates, as well as areas with the best long-term growth potential. We just added a long-term growth score to ReVenture app to help you figure out what areas will be best to buy over the next 5 to 10 years. Dig into that data now if you're looking for the long term, because in 2026, you are going to start to see some more deals on the market, some more attractive price cuts, whether you're a buyer or an investor. So start researching now. Sign up for our annual plan to get a 32% discount to the monthly rate and lock in this data. It's only $33 a month on the annual plan. A very affordable price compared to the price of buying a house or investment property in 2026. So lock in that data now. Download the ReVenture mobile app and upgrade.
Yeah, he would definitely get me on that 1 year plan. I would, when it's time for me to move, I will buy that, you know, pay the annual 1 year thing and just rock it out, man, just to get that information, because it's crazy out here, guys. It's crazy out here. This is just the beginning. Yeah. So remember, man, y'all saw it here first. Like, please keep up with ReVenture Consultings and EconoFin. There's a few more out there. Definitely worth your time. Like, listen to what they're saying. Watch these articles as they come out, man. Wall Street Journal, any of the business publications. CNBC talks about it. C-SPAN talks about it a little bit. Not C-SPAN. CNBC talks about it a little bit. Like Squawk Box talk about it. But you gotta, those, when they talk about housing and the affordability and all that, it's just real quick. It's just real quick. They're not like really focused on it because of all the other stuff that's going on. But yeah, just kind of read up on it. You know, all the big newspapers tend to put stuff out. Here in Tampa, the real estate market is, man, is bad. Like, it's getting worse. And I mean, it's going to be good for some people coming into the market, especially if you know, the Trump administration said they wanted to remove all of the institutional money. And if they manage to do that, it'll definitely just, you'll see drastic drops in pricing. But the thing is, insurance down here in Florida is still a huge problem. So it's one of those things where you can afford the home, but you can't afford to insure it. You know what I mean? Because the insurance is crazy. Association, you look at these high association, look at $1,000 in association, and then you might be paying $1,100 to $1,500 in insurance. Then you got to pay your mortgage. So it's still, even though the prices are coming down, it's unaffordable. It's just one of those things. We got team ownership in the building. What's good, sis? I am the single ones in the building. Yo, sis, what's the market like up there where you are? What's the market like up there in the Chicago area? Is it still good? Because I know watching your content, and I got to admit, I haven't had time to really watch that much lately because I was doing a whole bunch of stuff, but now I got time freed up. I'm not, you know, you guys going to see me back to my normal schedule. I'm not working, doing what I was doing before. I'm doing other things now, so I have more time at home. That's tied to that announcement I'm going to have for y'all. When I could talk about it, I'll tell you what happened. But I can't talk about it yet. But what's going on in Chicago? Because the market was good when we would talk. You know, we've done collabs, and the market was good up there in Illinois, in the Chicago area. I don't know where it is right now. It's like, talk to the local realtors in your area for the most relevant info, facts. I'm just talking. I'm not an expert. talk to your realtor, talk to the folks in the business, you know what I mean? Talk to your lending institutions, like make sure your credit score is on point, make sure you're getting everything you want. Definitely talk and find out what's going on. She said she exposed Trump's ill stunt. I need to check that out. Chicago is amazing, best market to invest in. That's what's up. I know, again, I got friends who are doing well and they look for investment opportunities all the time. And I know that Cincinnati was on their list. And they're like, you know, I was kind of looking in the Cincinnati area. I'm like, oh yeah, it's still great deals in Cincinnati. We saw what they were talking about with Toledo, and Akron. But yeah, it is what it is. You see, like, you're biased though. About the Chicago market. Yeah. I mean, everyone's going to see this correction. I think this correction is going to hit every corner of the market here in the United States. I mean, the correction has to come. Either the correction has to come reference prices in the real estate market, or a correction is going to have to come with respect to income. People are going to have to make more money. And it doesn't seem like people are going to make more money. Like, even the Feds, the only person in DC that wants to raise the minimum wage seems to be Bernie Sanders. I mean, I think federal minimum wage is still around $7 and some change, if I'm not mistaken, which is insane. Insane. Like, here in Florida, minimum wage was $14 an hour and it's going up next year to $15 an hour. Florida. Can you imagine that? I think California, I want to say they're at $20. They're trying to get to 25. I mean, it's just a mess, bro. So if people aren't going to get paid more money, then the housing market is going to have to adjust to meet them where they are. And that's where we are right now. If wealthy people in the investor class stops investing, Blackstone's getting rid of all their properties, the law might change to force, all institutional money out of single family homes. I think that's a great thing, but that's going to have a serious effect on what's going on with our economy. And there's going to be a major effect overnight. So if that were to happen, again, I think it's great for average folks, but it doesn't mean that people are going to be able to run out right away and get a property. Like, next time we talk about money, we're going to talk about the debt crisis. We're going to talk about buy now, pay later. We're going to talk about what's going on in the auto industry with all of the repossessions. And what we didn't talk about, there's a spike in foreclosures in America, and that is growing. So we still got more to talk about. Yeah, she was like, Cincinnati's cool. Cincinnati is cool. The Cincinnati real estate market, man, I was surprised at the numbers. In the return on investment in that area, like Hamilton County and the surrounding counties, is really good right now. And again, but that could change. But the market there is kind of locked in their own little thing. So I don't think that market is going to get hit that bad. Will there be an adjustment? Yeah, maybe a few percentage points. It might correct down a few percentage points, but that's not going to change anything. Unlike here, like what they were showing, what Reventure app was showing, what's trending down, like the percentage wise. You got people, I mean, $100,000 off the ask. You got people down here, bro. If you're trying to sell your place, you have to aggressively price it and hope that they can afford the insurance, no matter where you are in Central Florida. So anyway, that's it. That's all we got for you guys today, man. I hope you enjoyed it. I'm definitely going to keep my eye on what's going on. Again, I am no expert. Please, please, please talk to professionals. If you're thinking about buying a home, I'm not an expert. I would say hold off, maybe keep your eye on the market and watch these changes. Why buy a place now where, you might be able to save yourself hundreds of thousands of dollars if you just wait a few months? But it's like anything else. If that's your dream home, that's where you've always wanted to live, you can afford it, you're locking yourself in for 30 years, then go for it. I mean, if you're good, you're not stressing yourself out, you can afford it, go for it. Just understand, like, you're still near the top, and, don't get mad if next year you get neighbors to come in there and bought the same place for way less. So, but that's what I tell folks. Like, if that's what you really want, that's what you want to do it. But you got to do your due diligence, check into it, make sure you talk to the pros, make sure you get the numbers, make sure it makes sense for you and your family. You know what I mean? If you're religious, pray on it, whatever, and then go ahead and pull the trigger if that's what you want to do. But just understand the market is rapidly changing right now. So keep your eye on the market. Just keep your eye on the market. So next time we get here, I think we're going to talk about cars. I'm going to try to get my hands on someone in the industry. I do know a few people in the car business, so they can tell me what's up. I'm trying to find someone who recently got out of the car business so they'll tell me the truth. Because, you get someone in the business like, no, everything is great. Come down and let me sell you something right now. Like, nah, bro, what's really going on? So even like if you got a brand new Ford truck, you got a Ford vehicle, you might not even be able to get your vehicle worked on. You might not be able to get your warranty work done because they're having a hard time keeping their mechanics. Like Ford and other dealerships are having trouble. So that's something we definitely want to talk about. Could you imagine you bought yourself a $80,000, $90,000 truck at your Raptor with all the bells and whistles, and you need to bring it in for something to get fixed, and they can't get you in? They're like, oh yeah, we're gonna have to keep your car for like 2 or 3 weeks. What? I'm paying for this vehicle and I can't even drive it because y'all don't have any mechanics? So I think next time we get together and talk about this sort of thing, that's what we'll talk about. The next time you see me, we'll be talking about some red pill stuff. And let me close with this. Let me pull up the red pill lens. I'm just going to pull up one of the videos from the red pill lens. That is the faceless channel that I do on the red pill stuff. And those videos are short, guys. I do I think the longest video I have might be 8 minutes. So we're going to do a short one. We'll do like a quick little. Here we go. We'll do this. How simpletons destroyed the modern dating game. Let's pull this up real quick. Hold on. Let me pull this up. You guys can check this out. So yeah, I really enjoy doing the faceless video thing. The faceless YouTube channel thing. And the thing that gets me, guys, now that I'm editing and, kind of doing what EconoFin was doing, I look at these videos closer now. Like, you're doing your B-roll. I'm looking at their B-roll like, okay, why are they using this and why are they using that? Because it helps me get better. But let's check out this video, man. This is from the Red Pill Lens. This is about simpletons. Simpletons destroyed the game, how men lost leverage in modern dating. And then y'all let me know what y'all think. We're going to watch this, and then I'm going to wrap it up. All right, so here we go. Let's stop lying. Women didn't destroy dating. Simpletons did. Men who kept playing by old rules in a new world and paid for it. Dating used to have purpose. Women dated with marriage in mind. Time mattered. Choices mattered. Dating someone you didn't see a future with was a waste. Those rules are gone. Today, many women date for experiences. Expensive restaurants, trips, parties, lifestyle access. Social media convinced average women they're celebrities, and simpletons fund the fantasy with free attention and free money. Some women won't show up unless you send money first. Cash app payments, luxury dinners, trips for a minute. She shows up, takes pictures, eats, and leaves. Why? Because men keep paying. Simpletons believe they must prove themselves, so they lead with their wallets. They don't realize they've turned dating into a transaction. To some women, you're not a romantic option. You're a sponsor. Then they complain. She's shallow. She's a gold digger. Here's the real question. If you believe that, why do you keep paying? You reward what you complain about. Dating follows incentives. As long as men comply, demands increase. Simpletons didn't just join the chaos, they created it. The solution isn't debate, it's boundaries. If she won't meet for coffee or ice cream, she's not interested. If she demands money before a date, she's not interested. Attraction doesn't need bribery. Simpletons destroyed the game. Don't keep funding it. Stop paying for strangers. This has been a look through the red pill lens. Like, share, comment, and subscribe. Remember, no one is coming to save you. Do the work. Good luck out there, gentlemen. Peace. That's what we're doing over there. That's what we're doing over there, man. So if you guys don't mind, I would truly appreciate if you just, pop in over there. And, comment, like, subscribe, all that good stuff. I am a single one. I know that's her favorite stuff right there. So that's what we're doing over there. Next time we get together, we'll be talking about some red pill stuff. And I completed all of the ebooks. We got them all done. I got 16 done. I think I'm gonna write one more just because. And so that thing is going on pretty good. I'm working on the Gumroad platform right now. So I'm getting that all set up. And then those ebooks will be available for purchase for those people in the red pill world who like what we're putting out there. You can support by just, getting one of the ebooks. And as soon as we get that up and running, I will post here so you guys know where it is. Setting up a website. I'm doing all sorts of stuff over here, guys. And we're also going to be not just doing red pill stuff. I'm going to move into, there's a lot of people asking me about comedy, like, hey, what stand-up class should I take? And I'm always like, bro, you don't take a class for stand-up, but they insist. So I'm like, I'm going to set up some sort of stand-up one-on-one kind of thing. I don't know what I'm going to call it. And it's just like a checklist, like, hey, if you really want to do stand-up, this is how I suggest you do it. And if you're looking for some sort of mentorship or whatever, I'm going to offer some really inexpensive products that can help you get started on that, which include me actually maybe not critiquing, but, kind of going over your material and kind of, giving my 2 cents, make a coaching. We'll just call it stand-up coaching. I give you a little coaching on, how to, set up punchline kind of stuff, how to handle a heckler, how to set your rates, how to approach businesses if you're trying to bring in, like if you want to promote a comedy show and you want to produce a show in someone's business, how to do that. So that's coming as well. Bro, we got a lot we're doing in 2026, man. We're getting at it. So it's like, it reminds you of spoken word. That's what we're doing over there, man. And bro, I'm telling you, man, Brother Pitt, go over there, check it out. I did one on the family law trap. That's a good one. Check that one out. And again, I try to keep the message medium. I'm not trying to go full blown crazy red pill. I'm not trying to go mainstream. I just want to plant the seed and just get people thinking a certain way. And one of my biggest messages is this, man. Don't be blaming women for your shortcomings, bro. We don't need to be doing that. We don't need to be doing that. And as far as spoken word, that's on my bucket list. One day I'm gonna do some spoken word. I even wrote a few poems years and years ago that I never got a chance to perform. But we'll get there. That's one of those side jobs I'm gonna set up out there. I'm gonna get in there. So anyway, man, I really appreciate y'all for rocking out with me. Thank you so much for being here. Y'all know how we get down, man. I'll be back probably Friday. We'll probably do Friday. We might even make it a Lit Saint episode. I'll definitely be dropping a recorded video tomorrow. I'm not quite sure what I'm gonna talk about. We'll be talking about something. It'll be worthwhile. Appreciate your support. Thanks for rocking out with me, guys. This is I Really Want to Know podcast. I'm DL Saint. I'll see y'all soon. Peace.
Nothing like I've ever seen. It's just a thing of beauty.
Darn, that's the end.
Thanks for watching. Really appreciate your support. And if you like that video, check out this one or maybe that one. We'll see you around. Peace.